Let's now talk about when the parent acquires the subsidiary and the subsidiary remains separate incorporation. If the subsidiary remains in separate incorporation, it means that the subsidiary has its own accounting record. So it differs from the first case when we talk about where the subsidiary actually dissolves. When the subsidiary dissolves, its accounting record closed, so the subsidiary does not exist anymore. But when the subsidiary remains separate incorporation, it means that the subsidiary will remain its accounting record year after year. So compared to dissolution case, where the subsidiary actually has no accounting record at all, and consolidation only happened once, which is when the acquisition happens, when the subsidiary remains separate incorporation, consolidation actually happens every year. So the first step before we do consolidation is that we have to allocate the consideration transfer by the parents to acquire the subsidiary. If we look at the book, I want you to read the book before you look at the video. It's that the parent pays $2.62 million to acquire the subsidiary. The book value of the subsidiary is $600,000. It can be seen here. So the net asset, as we discussed in the first chapter, what the parents bought is the net asset of the subsidiary, and it's the book value of the net asset that the parent company that is acquiring. So the parent company acquires the subsidiary's book value of net asset at $600,000. It means that the parent pays $2.02 million more than the book value. Why does the parent pay $2.02 million more? There are two parts of the overpayment. The first part is the undervalued assets, liabilities. The second part is what we call the goodwill. If we look at the information part, we can see that, for example, the computers on the book is $400,000, but the fair value is $600,000. So basically, the computers and equipment are undervalued by $200,000, which should be allocated to the excess payment. The same idea persists. So you will see that the capitalized software, customer contracts, and notes payable are all undervalued. One thing I want to point out is the notes payable, which is the liability. If you look at the notes payable on the book is $200,000, but the fair value is $250,000, so it's undervalued by $50,000. This means that the parents, after acquiring the subsidiary, needs to repay the debt at a higher number. So when we allocate the excess payment, it becomes a negative number because it is the parent's liability to pay more. So if we add all these things up, it's $1.95 million. Take the difference between the two, which is the overpayment minus all the undervalued identifiable assets and liability, leads to the calculation of the goodwill. Now let's take a look at the demonstration of the worksheet. How do we use worksheet to derive the consolidated financial statements? This is consolidation at the date of acquisition. So the first thing we need to do is that we need to copy the big company, the big net, and the small port company and their financial statement at the end of the year to the worksheet. So if you look at this Excel sheet, it's the worksheet that we need to consolidate. For the sake of easiness to explain, I add a column which shows the fair value of all the assets and liability of the small port, which is the subsidiary. I also show the goodwill here, just to be easy to explain easily. Before we use the worksheet formats, I want to first introduce the way that we predict the correct number of the consolidation. At the acquisition date, as we discussed in the textbook and the notes, it's not important to consolidate the income statement and the statement of retained earnings, because the subsidiaries' earnings are earned before the acquisition. So anything happens before the acquisition shouldn't be included at the consolidation at this particular day. So we do not include the income statement and the statement of retained earnings because of this. We look at the balance sheet first. So when we look at, for example, the consolidated current assets, by consolidation we mean to add the two companies' financial status up to reflect the financial status of the whole group. So if we look at the big and small, by the acquisition method, we know that the current asset should be the consolidated. Now this is the predicted consolidated number I want to show you. So the consolidated current asset should be the book value of the parent's current asset plus the fair value of the subsidiary's current asset. So this number should equal to the parent's book value plus the subsidiary's fair value. The consolidated investment, however, should equal to 0 because, as we discussed, the investment number it's a double counting. The investment of subsidiary, it's basically the subsidiary's book value of equity plus all the inflation, I call it inflation, or the difference between the fair value and the book value, as well as the goodwill. So basically the investment accounts, if we look at the allocation, the investment account 2.62 million is the book value of the subsidiary plus the excess payment for all individual assets and liability and the goodwill. So we need to take we need to take this account out because it's a double counting of the assets and liability of the subsidiary. Similarly, we can calculate the computer, which is the book value plus the fair value of the subsidiary, the software, the contracts, and the goodwill is basically just the goodwill. I'm just going to copy the equation to be simple. The same applies to the notes payable. In the textbook, there's a contingent payment that the parent pays. The idea is that if the subsidiary reach some earnings target, the parents will pay extra money to the subsidiary's shareholders, which is also counted as the liability of the parents. So it wasn't in the book of the parents before acquisition, but it is after the acquisition, so I labeled it in the red. This idea is not very particularly important during our course, but I want you to just get the idea. So this is the same. Basically, all the assets and liabilities are calculated. So take the sum of the above and the liability too. Okay. Now equity. We discussed this in the text, and the lecture notes that the equity of the whole group, of this whole company, is basically the shareholder of the parents. So the equity, when consolidated, that's what we predicted, should be only the parents. So it should only be the parents. The same here. And the total equity is calculated by adding the above up, and total liability plus stockholders' equity equals to liability plus stockholders' equity. So if we look at the liabilities and the total liability and equity, it equals to the total assets. So we know we basically reached a balanced balance sheet. Okay, so this is the idea. The idea is that all the assets equals to the parent's book value plus the subsidiary's fair value, and all the liabilities are the same. The equity only includes the parent's equity. Alright, the idea of the worksheet is to show how we can derive the predicted, which is the correct number. So if we look at the consolidated column, it should start with the simple math just to add the two book values up. I want to make sure you understand now the fair value is not relevant anymore, because this I don't want to hide it, because I just want you to take a look at the fair value. The fair value does not matter for a moment, because when we start consolidation, we always start with the book value of the two companies. So you don't put the fair value here. You just put the two book values of the two companies and try to add them together, which is the first step. So if you look at my formula, it's basically the two numbers added up. But if I have any adjustment here, debit or credit, I plus the debit and minus the credit. So if we look at the consolidation process, we will see that we first add them up. And the second thing is that we need to adjust, because if you look at, for example, investment, if you add them up, it's to 620,000. All numbers are in thousands. And our predicted investment is 0. So we need to basically take out the investment account completely. We need to process what we call the adjustment. So we need to use some adjustment entries to help us to reach the correct number that we want to reach. In this case, because it's all acquired we consolidate at the date of the acquisition. So there are two entries that we need. If you read the text, you know these two entries are called the S entry and the A entry. Basically, what we did is that we first, the S entry basically take out the book value of the small port. The A entry actually restore all the assets and liability to the fair value, and also recognize the goodwill. After we do that, the investment account will go to 0. Now I'm going to show you how I'm going to do it. Let's first start with the S entry. The S entry basically takes out, as I said, basically takes out the book value of the subsidiary's equity. What we do here is that we first start with the subsidiary's stockholders' equity. We need to take away we need to eliminate the stockholders' equity with the S entry. So because it's all in the credit side of the journal, the general journal, so we need to use a debit to take it out. So let's debit this number. The same here, we debit the additional paid-in capital. We also debit the retained earnings at the December the 31st, because all the retained earnings here are bought in the investment account. So if we add these three things up, this is called the S, which S stands for stockholders' equity. Let's add all these things up, and we credit our investment, because investment is on the debit side. So we want to add all of them up. You can see this is exactly what we have been purchased, which is the book value of the small port. So our S entry basically takes away the book value of the small port of the investment. The second thing we do is we need to restore all the assets and liability of the subsidiary's book to its fair value. For example, if we look at the consolidated number here, which is simply adding the computers of the two companies up, it's 1.7 million. but it's actually should be 1.9 million. So the difference is exactly the $200,000 here, which the computer's fair value differ from the book value. So we need to use a entry that's called the A entry. The A entry basically increase the book value to its fair value. So it should be on the debit side of 200,000. This is called the A entry. The same here, the difference will be 11,000. So, and the contract will be 700. The goodwill will be 70. If we want to remind ourselves, the goodwill is also calculated in our allocation. Notes payable undervalued by 50,000 because it's on the credit side. We need to credit the 50,000 here. Okay, all these are our A entries. Okay, so if we add all these A entries up, this is 2.12 million. This is the negative number. I'm sorry. Negative 50. It would be 2.02 million. If we look at allocation, this is exactly what we have. So if we add these two things up, and it's on the credit side, it cancels out with our investment account. Our investment account becomes 0. And this all because we use the two entries, which is the S entry and the A entry. So again, S stands for stockholders' equity. It takes out the stockholders' equity of the subsidiary, makes the consolidated stockholders' equity the same as what we predicted. If we add them up, simply add them up, we add up the parent and the sub, but the shareholder is of the whole group is the parent shareholder. So we shouldn't add the subsidiary shareholders to the whole group's financial statement. The same here, we basically restored all the book value of the assets and liability to the subsidiary's fair value. So it makes our consolidated number the same as what we predicted before we do the worksheet. Okay, after this videos, I hope you have a better idea how we do the consolidation with the worksheet. I just want to show you if it's an investment account, okay? If this is an investment account, the investment account is the cost of the investments, right? And at the acquisition date, it's only the cost of investment. So the cost of the investment can be break down into two parts. So this cost are two parts. One would be the book value of equity of the sub and book value of equity. I don't know why it always says book value of equity. And I don't know what's going on. It just wouldn't let me say book value of equity. And the second part would be the excess payment of the assets and liabilities plus the goodwill. Okay, so if we look at these two parts of the cost, we know we use two different entries to eliminate these two parts. The first part we use S entry. The second part is the A entry. So the S entry basically equals to the subsidiaries common stock plus the subs additional paid in capital plus the subs retained earnings on December the 31st. Okay, excess payment will be equal to all the assets and liability fair value minus the book value, which is the excess. You can see, for example, here it's just the fair value minus the book value. So all the A entries are the fair value minus the book value plus the goodwill. I just don't want you to forget the goodwill, so don't forget the goodwill. Alright, so hopefully after this video clips you understand how the worksheet works. Thank you.